Elon Musk and Jensen Huang are building a future to be excited for. And here's Dan Ives explaining it to you.
But I have a lot of viewer questions for you. Before I get to that, I do want to ask you your 30-second bull pitch for Tesla and your 30-second bull pitch for Nvidia, because I know you're very, bullish on both of those names.
Yeah, look, on Tesla, this, in my opinion, is the most important chapter ever for Musk and Tesla, the AI chapter, autonomous and robotics. I think we're talking 2-3 trillion in terms of market cap, best physical AI play besides Nvidia. When it comes to Nvidia, the godfather of AI, there's only one of them, and that's Jensen. And look, demand to supply is 10-1 for Nvidia chips. Get the popcorn out, get the watch parties out for next week's earnings, because this is, in my opinion, is going to be a $6 trillion market cap in 2026. And again, the bears will continue to yell from hibernation caves. They'll be wrong.
All right, they'll be wrong. You heard it here first. But let's get to some of our social questions. And I want to start with Tesla. One social viewer asks, Tesla seems to be a show me story with investors all in on robotaxis and automation, but that seems years away. How much patience does it take to be a Tesla shareholder?
It takes a lot of patience. And we've talked about it so much, on Yahoo and on the show, because this is what you have to have the understanding of what Musk and Tesla are trying to do here. They're building out the AI future. Autonomous, they're going to own 80% of the autonomous landscape, in my opinion, over the next decade. Robotics, Optimus, that's what you're playing for. It's less about deliveries. It's more about the AI future. You have to be patient, but it goes back to this, in my opinion, is going to be the most important chapter ever in Tesla's story.
All right. Another question from our audience here, Dan. You've compared the AI boom to a party before, and that we're still early on in the night. Do you have any new analogies for where we are in the AI trade right now?
Yeah. So look, it was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m. And it's my view where, look, you're going to have glass on the dance floor, DJ stops playing music, but that party is going to continue to rage on. The Bulls and the Bears meet up at 6 a.m. at the diner. Bulls had a lot better night than the Bears.
But Dan, my mother always told me nothing good happens after midnight. So how do you know when to leave the party?
Look, and that speaks to my view. It's all, when it comes to AI, it's all about demand, right? 3 million air miles the last 25 years. I'm always in the road trying to understand what demand looks like. I was in Asia for a month. Demand's accelerated 30% over the last 4 or 5 months. So look, I get some on the valuation, but when those call an AI bubble, they're underestimating the scale and scope of this AI revolution. And for the first time in 30 years, the U.S. is ahead of China.
All right, I'll tell my mom for the AI party, you have to stay all night long.
Dan Ives' demand acceleration numbers expose why traditional valuation concerns miss the scale of what's actually happening in enterprise AI spending. Dan predicts $3 to $4 trillion will be spent on AI over the next 3 to 4 years, an amount he believes will surpass total tech investment over the past decade or more. Tech giants Amazon, Google, Meta, and Microsoft combined increased their capital expenditure from approximately $151 billion in 2023 to $250 billion in 2024 and are predicted potentially surpassing $320 billion in 2025. Dan's constantly traveling and meeting with CIOs, CTOs across different industries and seeing demand patterns that Wall Street analysts sitting in Manhattan offices completely miss. That 30% acceleration in demand he mentioned is a critical point. Most analysts look at current revenue and extrapolate forward. They see Nvidia or Palantir growing at certain rates and assume that growth will slow as the market matures. But Dan is seeing the opposite. Demand is accelerating, he thinks, not decelerating. Companies that started with pilot programs are now deploying at scale. Enterprises that waited on the sidelines are rushing to catch up. The capital expenditure numbers tell the real story. When 4 massive tech companies increase spending by 63% year over year, that's not a normal cyclical investment. That's transformation happening before our eyes. They're building entirely new capability stacks from the ground up. So Dan's forecasting a $2 trillion capital expenditure cycle over the next 3 years as enterprises and governments ramp up on AI investments. So this isn't money going into consumer apps or marketing campaigns, it's going into data centers, chips, networking equipment, and the software layer that sits on top of all that hardware. And this is why Dan's party analogy works. Tech gets hot, money pours in, valuations spike, then reality hits, and everything comes crashing. The dot-com bubble, the crypto boom and bust. People assume AI will follow the same pattern. But Dan is arguing that this is fundamentally different. The spending isn't speculative, it's strategically necessary. If you're a Fortune 500 company and your competitors are deploying AI that cuts costs or accelerates product development, you don't have a choice. You have to invest or fall behind. And the demand to supply ratio Dan mentions for Nvidia chips is a key aspect. 10 to 1 means companies want to buy 10 times more chips than Nvidia can produce. That doesn't sound like bubble behavior to me. Bubbles happen when supply floods the market and nobody wants to buy. This is the opposite. Production constraints are the only thing limiting growth. And the US versus China framing matters too. This isn't just corporate competition, we're talking about geopolitical strategy. American companies and the government understand that whoever dominates AI infrastructure will have massive economic and military advantages. That creates political support for continued investment even if short-term returns don't justify it. But Dan's most interesting argument is about who's getting the timing wrong. Dan's criticism of people calling this a bubble is interesting when you think about why focusing on current valuation causes investors to often miss major technology transformations. Dan dismissed concerns about elevated valuations, stating that if you just look at 1 year or 2 year valuations, you miss every transformational tech stock from the last 20 years. Enterprise AI budgets grew beyond already high forecasts, with enterprise leaders expecting an average of 75% growth over the next year, and innovation budgets dropping from 25% to just 7% of spending as AI moves to core IT budgets. This is where Dan Ives is different from traditional Wall Street. Most analysts are trained to look at price to earnings multiples or price to sales ratios and compare them to historical ranges. When stocks trade above these ranges, they get nervous and downgrade. Dan is saying that entire frameworks fail during platform shifts. When technology fundamentally changes how businesses operate, the old valuation models don't capture what's happening. You're not valuing incremental improvement, you're valuing replacement of entire business processes. The shift from innovation budgets to core IT budgets is a key indicator. When companies first experiment with AI, they fund it from special innovation budgets that can get cut easily. It's a nice to have, but not essential. But once AI moves to core IT budgets, it becomes infrastructure. It's permanent spending that can compound year after year. That 75% expected growth rate is staggering. Normal enterprise software grows 10 to 20% annually in mature markets. 75% means the market is doubling every 18 months. That is pure transformation. Dan described the current AI infrastructure build-out as equivalent to building Vegas in the 1950s or Dubai 20 years ago, stating it's an arms race between the US and China where neither side can afford to slow down. This is why valuations look insane by traditional metrics. If you're building foundational infrastructure for the next economic era, current revenue multiples are irrelevant. You're valuing the total addressable market that gets created, not just near-term cash flows. That's why Dan calls for Nvidia hitting $6 trillion in market cap. He's not extrapolating current earnings, he's valuing their position as the essential supplier for an entirely new technology stack. The Tesla and autonomous driving example follows the same logic. If Tesla captures 80% of autonomous vehicle market, as Dan predicts, it's no longer a car company. You're valuing a mobility platform that replaces huge chunks of transportation spending. So the patience isn't about waiting for slightly better margins, it's about waiting for the market itself to materialize. One of our clients started with 0 audience. Now they're doing $100,000 months thanks to YouTube. And they're not alone. We've helped 3 businesses hit that level just by growing them a YouTube channel. Want to see how this could work for your business? Book a call with me below.